I would want us to start with APM, arbitrage pricing model. Is there anybody who is able to remember the arbitrage pricing model formula? Anybody who is able to remember the arbitrage pricing model formula? Is there anybody who is able to remember the arbitrage pricing model formula? Abracadabra. Yes. Great. Yeah. That's why I would want really to do this thing quite fast. And then we should be able to, all of us, today, it's a holiday, basically. A holiday for everybody, not for Muslims alone. When we have Monday being a public holiday, that's great. So somebody must be having something, everybody must be having something to enjoy tonight. But of course, not as I've seen somebody telling me that not beer. My students don't do beer. I don't have any student who does beer here. I don't have any student who does alcohol, not even wine. No. The only bitter thing we can take is alcohol. No. It's Coke. It's Coke. Coke is the most bitter thing that we can only have ourselves here. So APM, ladies and gentlemen, APM returns. APM is multiple factor model. And for us to get APM returns, normally we have risk-free plus expected returns of the security given factor 1 minus risk-free multiplied by beta 1 plus expected return of the security given factor 2 minus risk-free multiplied by beta 2 plus end of thinking capacity, etc. And then remember, recall this one here, premium. So as a quick way of recap, ladies and gentlemen, I would want us to do this question here. There's a small question of May 2016. May 2016. No, it's November 2019. November 2019, question 3C. November 2019, question 3C, 1 and 2. November 2019, question 3C, Roman 1 and Roman 2. Once you get this question, can you kindly put up your thumbs up like this? Once you get that question, kindly put up your thumbs. The question of Job Ochieng. So you're told here, Job Ochieng, an investor, believes that there are 3 important factors that determine the expected return of a particular common stock. Job uses the following factor betas and the factor risk premiums. So we have factors 1 to 3, we have factor beta, and then we have factor risk premiums. Then they have given us the risk-free rate is 5%. So they want us to give them the required return for the stock using arbitrage pricing theory model. So they basically want you to give them these APM returns, of which I'm so sure some of us will not be able to get because they have never looked at their book since we last saw each other. That is when they had to look at their books for the very last time, and then they shut down until today. That is when they are lifting up their books like this. I can see Kisaka there. So I'm giving you exactly 2 minutes. I don't know whether I should be able to give you some small money to motivate you people, But the good thing is that accountants are always motivated. Accountants are never motivated by money. So I'm giving you exactly 2 minutes, and then we get to compare notes. We get to see who is right, who is wrong. Yeah, SM is getting 12.75 or something. Yeah, these are very good students, really. Very good students, really. They're getting 12.15, 12.15. Is there any serious ninja who is wounded with this question? Any serious ninja who can't get that 12.15? Any serious ninja who is not able to get that 12.15, who is wounded with the question? It doesn't harm to be honest. It doesn't harm to be honest. Tell me, Mwalimu, I'm going to get that figure. Do the question. What do you use as expected return? I will be able to help there. Dixon, great. Wamboi, great. So remember, you don't even need any expected return really here. No, they have given you. So the most important thing is you to appreciate that they have given you premiums. So then how do we get these? How do we get these APM returns? So to get APM returns, ladies and gentlemen, we shall take risk-free. Plus this is premium one times beta 1 plus premium 2 times beta 2 plus premium 3 times beta 3. There are only 3 factors. All right. So APM returns will be equal to risk-free. Risk-free, which is what here, somebody, at least Paul, you're able to remember something there. You can see in this case here, the risk-free rate is 5. Are you able to see 5%? We leave away the percentages of 5. Premium 1. Premium 1 there, you can see it is 2.5. So I have 2.5, I'm omitting the percentages, times beta 1, which is 0.7. Plus, we have premium 2, I'm following this, which is 5, times the corresponding beta there, which is 1.2, plus premium 3, which is 6, times negative 0.1. So will that now give us 12.15? If you wish, you can put now the percentage like that. You can put the percentage like that. So is this now clear to all the ninjas who never got the question right? Is this clear? At least you need to box yourself. You know, ninjas, when you get things right, wrong, you need to box yourself a little bit. I will never get now this wrong. Now I've understood. Paul, are you able to understand now? Paul, are you able to understand? At least you asked a question there. These ninjas are not responding. So it's like everybody in this case here got it right. It's like everybody got it right. Now then, Roman 2, they want us to explain 2 differences between CAPM and arbitrage pricing theory model. So here we have a CAPM, we have a APT. So number 1, of course, this is a single factor model. This is multiple factor. That's very important. Remember here, it is a single factor, which basically is the market premium. But here we have got many factors, many premiums, and therefore many betas like that. Single factor, multiple factor. That's a very, very good difference here. Number 2, ladies and gentlemen, this is normally single period. And this, in this case here, can capture many periods, multiple period. So single period, you realize that CAPM can only handle questions whenever we are given like returns per annum. But APT, in this case here, can even take 10 years. Great. Ladies and gentlemen, remember here, number 3, very, very important. CAPM assumes normality. Assumes normality of what here? Normality of returns. Assumes normality of returns. Assumes normality of returns. So basically, CAPM assumes that if these are, for example, share prices of, say, Kenya Airways, that we must be having, in this case here, some average. It is this average where most of the stock prices here will be clustered. Yani kumaanisha kwamba CAPM inafuata kala ka ugali ka Mluya, ile concept ya ugali ya Mluya. Unajua ni Mluya pekee anaweza kapika ugali which can be cut into 2 equal parts. It's only a Luya who can make that kind of ugali. No other tribe. We must appreciate our key strengths. Our key strengths. Apart from Luya, is there any other tribe which can cook ugali that is symmetrical like this, which you can cut into 2 equal parts, 0.5, equal? Kalenjin, I'm married to one. I'm married to one, so I know their strengths. I know their strengths. Even Taita, I know their strengths. It's not in ugali. I feel proud. No. Oscar, no, it can't match. It can't match. Giriama, I know your strengths, not ugali. So, ladies and gentlemen, in this case here, APT can take care of any other distribution. So accepts other distributions. Accepts other distributions here. Skewed, leptocartic, etc. Accepts other distributions, even if they are skewed. Now, ladies and gentlemen, Tessos, great. But I thought Tessos are part of Luyas. Number 4, CAPM can only work when we have a benchmark portfolio. So a benchmark, I don't know why I wrote down here, kabisa. A benchmark portfolio, what we call market portfolio must be present. For you to use what we call CAPM. A benchmark portfolio must be present. And that is why we are saying here that CAPM. That's why we are saying here that CAPM returns equals risk-free plus ERM minus risk-free multiplied by beta of it. If this is not there, then there is no CAPM. CAPM, you must have that benchmark. So in this case here, of course, APT can work without a market portfolio. Actually, there is no market portfolio here. Can work without what here? Can work without a market portfolio. So in CAPM, there is what we are calling a benchmark portfolio or a market portfolio. It must be present for CAPM to be applicable. APT in this case here can work without that benchmark very comfortably, very comfortably. So that is the end of our recap, and I'm so happy because I saw over 50% of the ninjas got it right. Over 50% of the ninjas got it right. Over 50% of the ninjas got it right. Now we go to our second agenda today. Other distributions here. It accepts other distributions. Sorry, I think I rubbed very fast. These are enough. I don't want a lot of them, Nancy. You'll not be able to remember them. These are enough. Actually, 2 only. The ones that I would always want to see you guys quoting. Number 1 is the concept of what here APM is polygamous. You know, mama wengi. Lakini CAPM, in this case here, is single factor. And then the concept of single period and multiple periods. If you guys can remember those 2, I'm okay. Great. Ladies and gentlemen, from there, we go to the second agenda for today, which is what here? Determination of optimal weights. Remember, optimal means what here? Best, Best. Optimal means best. So if, for example, you want to procure like 2 securities to form 1 portfolio, I mean, what percentage of your money should you put in? A 60%, the other one 40%, or 30-70, which is the very best combination? the very best combination. I think there are students who are still asking questions. Thank you very much, Omboy. Number 4 on APT, yeah, can work without market portfolios. Okay, great. Can work without the market portfolio. So then I would want us to draw our eyes, to throw our eyes actually to August 2022, question number 1B. August, this has really been repeated. August 2022, question number 1, boy. August 2022, question number 1, boy. Let me know if we are already there. August 2022, question number 1, boy. An investor. Oscar knows how to get these questions very fast. Jarida, great. So we are told there, an investor decided to invest 2 million in the shares of 2 companies, namely Dela Limited. Dela. I think Dela ni aina address ya mama. Dela imeitwa namna gani? Dela Limited and Alpha Limited. The projections of returns from the shares of the 2 companies, along with their associated probabilities, are as follows. Dera, yes. Thank you, Kisaka. So we have probability, we have returns of Dela, and then we have returns of Alpha Limited. Look at the required there. They want us to determine the proportion of each of the above shares required to formulate a minimum risk portfolio. So for us to optimize, our aim is either to get the highest return or to minimize what we call risk. So it is either we get highest return, or in this case here, we get the lowest risk. So tell us there that an optimal portfolio guarantees, number 1, the highest what year? The highest expected return, or number 2, the lowest what year? Risk, the lowest risk, like that. Very, very important. So if you go to an exam where the examiner asks you to determine optimal weights, or determine, for example, proportions in the portfolio, which will make the portfolio get highest expected return or lowest risk, then you should be able to remember they want you to get optimal weights. I love this so much, optimal weights. So how do we get weight A? Weight A. So to get weight A, WA stands for weight of security A, in a portfolio. So to get weight A, ladies and gentlemen, normally what we do is to take the variance of the other one, variance of B, then we subtract covariance of AB, all over variance of A plus variance of B minus twice covariance of AB, So anytime they want us to give them weight, this is normally what we shall be doing here. To get weight, you take variance of B. There is an interchange. So if it's A, we start with variance of B minus covariance of AB, all over variance of A plus variance of B. And because there are 2 of them, then we say minus twice covariance of AB, minus twice covariance of AB, minus twice covariance of AB, like that. Twice covariance of AB. So let me know once you guys are able to write this formula up to here. Remember, WA stands for the weight. You can just put your thumbs up like this live. I'm on my second agenda item, and I'll be able to finish my stuff today very early so that I can release students here to do other great things. Today, people should do great things. So now we have our 2 companies. Which companies do we have here? We have a company known as delta, another one known as alpha. Delta and alpha, delta and alpha, delta and alpha. So remember, this is weight of A. You take standard deviation of the second company, you square, minus covariance of AB, all over variance of A, plus variance of B. When I square this, I'm going to call variance. So variance of A plus variance of B minus twice for variance of AB. You'll be able to understand this. You see now we have weight of delta and the weight of what here? Alpha. So of course I will start with the weight of delta. This is delta. So to get weight of delta, that I'll take as D, is there someone who can write the formula for us? Let's write the formula. Weight of delta equals who? Weight of delta equals who? Weight of delta equals who? Very easy. Weight of delta equals who? So I have to start with standard deviation of alpha squared minus covariance between AB all over variance of A plus variance of delta minus twice covariance AD. This is a lie. It's supposed to be AD because now it is delta and alpha. So very easy. They've already given me the parameters. I have them. I can see returns of delta in percentage. So I can see RD and I can see RA in percentage. So I can see 6.7 minus 3.514, 6.7 minus 3.514. And then for A, I can see 8.5, 14 and minus 1. 8.5, 8.5, 14 and minus 1. So 8.5, 14 and minus 1. So, and then probabilities are given 0.2, 0.25. 0.25, 0.3, like that, 0.3. So from now, this information and the formula given here, is there anybody who has confidence that they can be able to give me the weight of D from the information given here? Because you know already I've covered the entire topic really. Is there anybody who has a confidence that they can calculate everything needed? Yeah, everything needed here. I mean, it's ready. It's ready there. Yes. Because the very first thing that I would remember here is to calculate the expected returns. We calculate the expected returns first of all. Because these are dancing returns. I need an evened out. I need an average. I need an average. I need an average. I need an average. So I'll come and give my examiner expected return of D. So this is the Tata thing, the Tata thing. So expected return of D. So we have here Tata, actual returns times prop. So 6 times 0.2 plus 7 times 0.25 plus minus 3.5 times 0.25 plus 14 times 0.3. Are you guys able to give me an answer here? Expected return. So we have here sum 6.275. 6.275. Then go ahead and give me expected return of alpha. So probabilities are shared. So 8 times 0.2 plus 5 times 0.25 plus 14 times 0.25 plus minus 1 times 0.3 times 0.3, which then will end up giving us what figure? 6.05, right? So I hope we are together with everybody up to there. I hope you are together with everyone up to there. Great, thank you so much. Now from there, I'll go to spread. I'll go to the standard deviation. So from there, I'll go to the standard deviation. From there, I will go to the standard deviation. So standard deviation of D. Let me see what these ninjas will write down as the standard deviation of D themselves. Let me see what they will write down as the standard deviation of D. Very easy. As the standard deviation of D, I'm so sure there must be a ninja who is trying to peruse through to see their earlier notes. There must be actually like 2 or 3. And I can see them, fortunately, vividly. I can see them perusing through their pages. This is very easy. You see, I've got 2 types of returns of D. I have what we call the actual return and the expected return. So I have here RD, because division means subtraction, RD minus ERD. In terms of sum of what here squares times probability. And then I'll be able to come and do what here? Square root like that. So then we have our actual returns of D. They are here, all of them. So we have here 6, we have 7, minus 3.5, we have 14, minus. Expected returns of D, we have this 6.25. 7.5, I mean. This doesn't change. This always remains the same. So probabilities we have here 0.2, we have 0.25, we have 0.25, then lastly we have 0.3. So now you go slowly, you open brackets. You say 6 minus 6.275 rows, you square times 0.2, you give me an answer. Square times 0.2, you give me an answer. Tell me what are we getting? So according to Linder, 0.015, 0.015. 0.015. Yeah, we can agree to just restrict everything to 3 decimal places. We can restrict everything because you've studied here. We restrict everything to 3 decimal places. I mean, there's no harm. 3 decimal places, those are quite nice. Then we got the second one, 7 minus this, close, squared. 0.131. 0.1. Please, everybody, get out your calculator. I'm finishing this topic. Everybody, get out your calculator. Don't write our answers. If you see students getting behind, being left behind, it's because they've taken a backstage. They don't want to participate. This is very easy. You open brackets here, minus 3.5 minus 6.275, you close, squared, times 0.2. So the third figure, is there somebody who already has the third figure? The third figure, I'm waiting for the third figure. 23.889. 23.88 or 0.90 doesn't matter. 0.889 doesn't matter. But let's be consistent with 3 decimal places. Let's be consistent with 3 decimal places. The last one, I'm being told is 17.90. 17.903. So you want the summation. So you come and sum for us. You want the summation, you go there and sum for us. Oh, this is supposed to be 17.902. I'm told it's supposed to be 902, not 903. 902, not 903. Let's be very, very accurate. Thank you very much for that. Then go ahead and give me the summation here. Because you see, we have the sum here. We have the sum here. They are changing. We shall not fight. We shall not fight. 41. They are changing. Let me change for the last time. They're changing. They're changing. Although we should not fight about small differences, really. I just want the final answer, 41.937. 41.9 or 38, isn't it? Or 38, whichever now, whichever. 0.938. 0.38. So now my case will be 0.38, others 0.37, no problem. Then, ladies and gentlemen, I want the standard deviation of D. So the standard deviation of D will be square root of 41.938, which will end up giving us what answer? The final one, because after you've taken the summation, then now we have the root. 6.476. 6.476, like that. Thank you so much. Now from there, ladies and gentlemen, we shall be able to go straight away to alpha. So we go straight away to alpha. Let's go straight away to alpha. So I hope this is clear really. So we go to alpha. Standard deviation of alpha. Difference between two returns. Which returns are these? Actual returns of A minus expected returns of A. And this has to be in terms of sum of squares times probability. And then we get the square root. Like that. We get the square root. So come and arrange your numbers. First of all, you start with the RAs. There are many, 8, 5, 14, -1, minus. And the expected return of A, I can see it is 6.05. So expected return doesn't fluctuate. Expected returns remains what you say? Expected returns remains the same. Expected returns remains the same. Times. Probabilities, they're the shared probabilities, they don't change. So we have 0.2, 0.25, 0.25. Then we have here 0.3. Please give me answers. So we start with the first one. So open brackets, we have 8 minus this, close, squared, times 0.2. What are we getting? 0.761. Remember, we are talking over 3 decimal places, 3. Let's be consistent. Let's be consistent, all of us. 761, thank you so much. So come to the second one, open brackets, 5 minus this, squared, times 0.25. 0.276. 0.276. We go to the third one, and ensure that you're picking up your calculator. You say open brackets 14 minus 6.05, you close, you square times 0.25. So you're getting 15.8 something, 801, 15.801, 15.801. And then now we have open brackets here, minus 1, minus 6.05 squared times 0.3, square times 0.3. So this gives us 14.911. 14.911. Then come and give me the summation here. Give me the summation there. 81.7. Is it 81 or 31? There's something which is blocking my, don't know what I could do to these things. It's really disturbing me. Ah. 31.87, 31.749. Thank you so much. The now square root of the same. Square root of the same. So square root, we are getting 5.635. Thank you so much. So according to this optimal weights formula, what other parameter do you think do we need? Is there someone who can tell me another parameter, another figure? There is something, one more thing that we need. Covariance tests. Covariance, yes, we need covariance. So can I rub this? We need covariance. Can I rub this? Yes, thank you very much. So we need the covariance now. So is there anybody who is able to remember the formula, covariance between D and A? Covariance between del and alpha. Anybody who is able to remember that formula? Very easy. We shall take the deviation of D times deviation A times probability we sum. So covariance between D and A will be deviation of D is RD minus ERD. Division of A is RA minus ERA times probability. There is a summation there. There's a summation there. So RDs, I'll now go and populate. I'll go very fast and populate this there. So we have 6, 7 minus 3.5, 14, minus. Expected returns of D. So we have 6.275, 6.275, 6.275, 6.275. Remember, the expected does not change. Then we have actual returns of A. They're here. 8, 5, 14, minus 1, minus. Expected returns of A are here, 6.005. Times their corresponding probabilities, 0.2, 0.25, 0.3. So are you guys able to get these numbers? You take your calculator, you say open brackets, 6 minus this number, close, times there, open, 8 minus 6.05, close, times 0.2, you get an answer. 3 decimal places. You want only 3 decimal places, remember, Susan? Only 3 to make things easy. Only 3 decimal places to make things easy. So I'm being told by Kabatha and Linda, Susan, I'm sure you're doing this well in your calculator. So we have here minus 0.107. Susan, check what you're doing. Just slowly, you open bracket, 6 minus 6.275. You must open those. If you don't open brackets, you'll get it 0. Times open, 8 minus that. You close times 0.2. Now you can go to the second one, and everybody's doing this. Everyone is doing this. Then we have tests. 0.19. Is it positive or negative, Linda? Negative, 0.190. Great. Then we go to the third one. Please ensure that everybody is punching their calculator. Everybody must punch their calculator. It is a prerogative. Wamboi is saying 0.19, but Wamboi, I know there's a negative there, Wamboi. Is it positive or negative? They're saying it's positive, imagine. They're saying it's positive. Let's repeat this, all of us. And I can see, yes, it's positive. Right, is it positive really? Because you see, this itself is positive. This is negative. So the final answer will be negative. I know why people will always keep on confusing. It's because they don't want to use their calculator like one off. So many guys would want to do this separately. They write down, they do this, they get it wrong. They keep on blaming their village witches. If you simply say, in this case here, open bracket, 7 minus this, you close, you say times, open another bracket, 5 minus that, you close, you say times 0.2, you will see the answer is negative. Let's first of all finish this. Let's clear the air. I can see Ken is saying negative 19.428. 428, and there is a ninja called Nancy who is telling us that the last one is 16 point something negative. Negative 16.338. All right, I can see a question there. Just like, for example, if you are given here Nancy 8 times 2 times, Nancy, can you kindly give me this answer? It won't matter really that whether I'm multiplying this. No, I'll always take my calculator Say 8 times 2 times 0.3. I say the answer once. I say the answer once. Nancy, just try this. 8 times 2 times 0.3. What answer are we getting here? Yeah, it can be the same thing. Don't try to put these things separate. I would want to multiply this on. No, this is a tripartite thing. All of it co-joined together. What I'm supposed to do is to get my calculator. I hope you're not using a mobile phone. You save is the last one. Open brackets 14 minus 6.275. You close. You say times, open again, minus 1 minus 6.05. You close. You say times 0.3 equals. And then please come and give me the sum there. The sum here will be my covariance. Number 2, I'm getting minus 0.19. Yeah, number 2 is okay. Number 2, Sylvia, is minus 0.190. This is what I have written here, minus 0.190. Number 2 is okay. So minus 36.064. Minus 36.063. Or 4, it doesn't matter really. Negative, yes. Thank you so much. Then I would want someone to go and take a step of faith and write for us that formula of WD. Just try writing. Don't look at anybody's answer. Even if you get it wrong, so what? Even if you get it wrong, so what? Just go somewhere there and write that value. Already Mr. Dennis has it as a final answer. Mr. Dennis seems to be a great black belt ninja. Black belt ninja. How about the other ninjas? Are they able to write that formula? And they should be able to substitute really. Let's see. Ruth says no, WD should be 0.53. I like this kind of arguments. When students argue like that, really that makes me happy because there is learning happening now. There is learning happening now. When students are writing down like that. And what I know, the students who keep always on writing in my class, they're giving answers. They're asking questions when they're not able to follow. As their father, I always speak a blessing to them. You'll never get a student who keeps on writing here failing. Never, never. Because I always speak a blessing to them, because I always believe in making noise in class. Hata kama uelewi ukiandika tu zero, so long as unaandika andika, kama unachora ka emoji kana kanacheka, ka emoji kingine upside down, ka emoji kingine. So long as unaongea, I always speak a blessing on you, and as your father, of course, unajua blessing ya father inakamata. Blessing ya father iwe inakamata sana. Class yangu kitu wezi najua wezi toboa is if you take a backbench position. You're not answering anything, you're not asking anything. That one I'll always keep on teaching you semester after semester. And you'll be wondering why. So weight of D is standard deviation of A squared minus covariance of AB all over standard deviation of A squared plus standard deviation of B squared minus twice covariance of AB. Twice covariance of AB. So we start with WD. So is there somebody who can remind Mwalimu what the standard deviation of A was? Anybody who is able to remind Mwalimu what the standard deviation of A was? Abracadabra. Standard deviation of A. Are you able to remind Mwalimu? We got it somewhere. We got that standard deviation of A somewhere. It was 5.635. So 5.635 squared minus covariance itself there is minus 36.063 all over. So variance of A, 5.635 plus, how about standard deviation? Angalia mimi nimesema B tena. Oye, inafaa kuwe oye, D for Della. This is supposed to be D for Della. D for Della, sorry. So is there somebody who is able to remind us what the standard deviation of D was? Standard deviation of D, 6.46, 6.476. Kabata. Ya D, ya dog. Ama tume-interchange. Kumbuka ni opposite. Here we have to start with standard deviation of A. Sijika tume-interchange. Kwa hivyo ni correct. Correct. Minus twice covariance of AD, which is minus 36.063. Please saidia mwalimu, tukiamua kupita tutu sisi wote kwa hii class. Mimi najua tuko nayo potential. Tukiamua kupita wote kwa hii class, tuko nayo potential. Tuulize maswali, tujibu maswali. So nataka kila mwanafunzi anipatie numerator answer. Useme 5.635 squared minus 36.063. Please give me the numerator value. Give me the numerator value. 67,812. 67,812 like that. Numerator value is 67,812. How about in this case here, the denominator? Take this out. 5.635 squared plus 6.476 squared minus 2 times minus 36.063. I'm being given a figure of 146, 145, 817. Abracadabra. Are these answers correct? Abracadabra. Is this answer correct? 818, 818, 817, one and the same. So then abracadabra, please give me this WD figure. Please give me this WD figure. If you want to pass, me, I can assure you 100%. This class is going to pass the whole of it. But we have a price to pay. Which price are we paying? We must ask questions. We must answer questions. So WD, I'm being given a figure of 0.46. WD is 0.46, like that. 0.46. Therefore, our WA will be equal to who? Therefore, our WA will be 1 minus WD, which will be 1 minus 0.46, which is 0.5 what here? 0.54. Our WA will be 0.54. 0.54. There is another ninja who will tell you, Mwalimu, I would rather use the formula than using these simplified things here. Some other ninja will tell you, Mwalimu, what if I use this other formula of getting WA directly, method 2, that I can come and say WA equals variance of del minus covariance of AD all over variance of del plus now variance of A, because there are two companies always. And because there are two down here, they talk of twice covariance AD. Well and good. You will still end up getting the same answer. So then let's try to prove this correct. So WA will be equal to, are you able to remind Mwalimu what the standard deviation of D? I don't want you to get the variance. Just remind Mwalimu, what was the standard deviation of Della? What was the standard deviation of Della? What was the standard deviation of Della? Just remind Mwalimu. What was the standard deviation of Della? What was the standard deviation of Della? 6.476. So 6.476 squared minus, because covariance itself is negative. So minus covariance between AD. So you write here two negatives, 36.063. All over variance of Della, it's again here. It is 6.476 squared plus variance of A. What was the standard deviation of A? What was, please remind Mwalimu for the very last time, standard deviation of A, 5.635. 5.635 squared minus twice this covariance, which is minus 36.063. So you go ahead and get the numerator. Go ahead, get the numerator. Go ahead, get the numerator. Great question there. Remember the two, whenever you add weight of A and weight of D, must be equal to 1. The 2 must always add up to 1. But if you wish, you can always use this long formula. So please, I want the numerator, please. I want the numerator. I'm being told it's 78. The numerator is 78. How about the denominator? You say 6.476 squared plus 5.635 squared minus 2 times minus 36.063. You give me an answer here. Give me the answer for the denominator to be fair to all the students. Give me the answer to the denominator. Answer to the denominator. 149,322. And therefore, in 2 decimal places, what will this weight here be equal to? So the weight of A will be 78 divided by 149.322, which will end up, so it's supposed to be 145, 145.82, 145.82, 145.82. Look at that. Thank you. Okay. Thank you, Obita. So 0.534, 0.534. I'm so sure it's because of rounding off errors. Otherwise, we should be able to get 0.54 as it is here. So therefore, weight of A is 0.46, which is 46%. And the weight of B, it will be 54%. If you rate 53.4%, well and good, well and good, well and good, well and good. So up to there, ladies and gentlemen, have we understood this concept really? Have we now understood this concept of optimal weights? There is a formula to cram there. There's a formula to cram there. Great, great. There is a formula to cram there. Then they want us to give them the amounts in shillings that should be invested in each share using the proportions determined in B1 above. Please give me this answer. Please give me that answer. Please give me that answer. The amount in shillings that should be invested in each. These ninjas wameanza kuchoka. Our ninjas wameanza kuchoka, oye. Because already you know the percentage and you know the amounts to be invested. In total, they're investing 2 million. Yeah. So amounts invested. Yeah, amounts invested. So you write there Roman 2. Great. So you have the answers now. So Della will be 920. Della will be 920,000. And then Alpha will be 1080,000. 1080,000. 1080,000. And this concept has been repeated not once, not twice, all through, and we shall be able to see that. Now write today's last discussion area. So the last discussion area for today is portfolio performance appraisal. 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 So we should be able to look at three areas. We have the Jensen's alpha value model. We have the Sharpe's alpha value, Sharpe's model. Let's call it the Sharpe's model. And then number three, we have the trainer's model, the trainer's model. So the moment I finish these three, so Nancy is asking all that for only 8 marks. Anyway, we shall overcome. Is it too demanding? I find that concept, Nancy, to be very, very basic. Actually, if I were to do it in my speed, I'm so sure I can finish getting those standard deviations very fast, within maybe 10 minutes. I don't find that examiner to be unfair there. I don't find that examiner to be unfair there with 8 marks. Or Nancy, you wanted to be given 20 marks for that question. Ninja Nancy, you wanted to be given 20 marks for that. No. That's very basic. Remember, that is what we began with. No. Then you guys haven't put in yet time to understand the formulas. I mean, we began this topic by doing covariance. We began this topic by doing the expected, by doing standard deviation. I don't find that question to be very technical. Actually, if you ask me, ninjas, they should squeeze that marks. They should squeeze those marks to 6. No. So tell them there is a concept you haven't understood, which time consuming. I mean, so tell, if you have ever attempted AFM, most of the times you guys will be looking at the ceiling. Most of the time you'll be looking at the ceiling. Instead of looking at I mean, you have something to be doing. We shall overcome. You can do it very fast, yes. A step aside, yes. You can do this very, very fast. You can do this very, very fast. So portfolio performance appraisal, Jensen's alpha value. Yeah, Paul is saying, Mwalimu, you avoid some concerns raised. Like which one? Please keep on asking. You know, handling a class of 120 is not easy. It's not easy. I try. You'll be surprised. Keep on asking. Keep on asking. You keep on, like, there's a way you can just, you don't have to type. Like now, do you expect Kisaka, honestly, me to remember that question? In total, at RCM, I'm teaching 11 classes. 11 classes. I can't remember. I can't even remember what I taught. Simply mention again. Just ask the question again. Keep on asking. At times, you can even call. All right. So then as we wait for her to type, so I normally don't ignore any questions, but in some cases, you know, those questions come up very fast. Today is my birthday. We need to celebrate this lady. Yeah. So today is let me in this case here mute. Let me mute here. Question number 5C, August 2022. Question number 5C. So we are doing it very fast. We are told the following information relates to the performance of, so we are doing performance measurement of portfolios. So the following information relates to the performance of 3 portfolios, A, B, and C, during the year ended 30th June 2022. So we have those 3 portfolios. We have expected return. We have standard deviations. We have covariance of portfolio return with market returns. Then number 2, we have standard deviations there of the market is 10%. So required, evaluate the performance of these 3 portfolios using number 1, Sharpe's performance measure. So number 1, Sharpe's coefficient. We normally call it Sharpe's coefficient, SC, very easy. To get Sharpe's coefficient, we normally take expected return of the security minus risk-free over standard deviation of the security, like this. Sharpe's standard deviation, Sharpe's standard S&S. Sharpe's, we always use standard deviation. So abracadabra, I promise to move very fast here. We have ABC. So A, is there somebody who is able to see the expected return of A? Is there somebody who is able to see the expected return of A? Expected is the same as average return. Average return. Are you able to see, is it 14 really? I doubt. I doubt. 17.55 is correct. So we say 17.55 minus risk-free. Are you guys able to see risk-free rate tuko chini? Risk-free rate mahali. Uko chini, risk-free rate ni ngapi somebody? Risk-free rate, not RM, risk-free. Risk-free ni ngapi somebody? Ni 7, eh? Risk-free ni 7, so 7. All over standard deviation of the security. Are you able to see the standard deviation of the security? Are you able to see the standard deviation of the security? 10, right? So I'm being told this is 10. Please give me an answer there. Aya. So fanyeni zote, tuone paka mwisho zinakuja namna gani. Abracadabra. Fanyeni B na C pia. Unipatie answer, kazi yangu mimi ni kumark tu sasa as we disappear. At the standard deviation ni 30. Woi. Standard deviation. Yes, I know what they're talking about there. No standard deviation of the market. Is standard deviation of the security, it's 30. You're right. It is standard deviation of the security, not market. Not market. It is standard deviation of the security. Thank you so much, you guys. That is why I'm teaching you. For you to become brighter than the teacher, you must become brighter than the teacher. Now I can see you are living what we are teaching you. So the first one, you guys are getting 0.3 what here? 0.35. The first one, you're getting 0.35 here. 0.35. The second one for B, is there any ninja who is getting 0.18? For B, is there anybody who is getting 0.18? And then C, what are we getting for C? Is anybody getting 0.08? 0.08. So in terms of performance, this will be rated number 1, the higher the better. This will be rated number 2, this will be rated number 3. The higher the better. So in terms of performance, you rate like that. And there are times, ladies and gentlemen, your examiner will ask you to get the standard, or rather the Sharpe's coefficient, the Sharpe's coefficient of the market. If the examiner asks you to get the Sharpe's coefficient of the market, then here, of course, you'll take here expected return of the market minus risk-free. All over what here, somebody, standard deviation of the market. This is a very special one. There are times the examiner will tell you to look for this figure. For this figure, Sharpe's coefficient of the market portfolio. So is there somebody who is able to see expected return of the market in this question? Is there anybody who is able to see expected return of the market? 14, right? Minus RF, which is what here? 7. Over standard deviation of the market, which is what here? Standard deviation of the market, which is 10. It is given there. It's given there. So I don't know whether we are together, all of us. Are we together up to here, all of us? Great. So this is a very, very interesting area. Very, very interesting area. And then if you allow me, within 3 minutes, I should be able to show you how to measure performance over a portfolio using what here? Trainer's model. Ya mwisho kabisa, 3 minutes. Within 3 minutes. 3 minutes. I hope you've been able to rank. These are ranks. The higher, the better. This is the highest. The higher, the better. The higher, the better. The higher, the better. So now it is trainers. Now it is trainers. So number 2, the trainers model. The trainers model, this basically is the beta, uses beta to measure performance To measure performance, we are using beta. And to be able to get the trainer's coefficient TC, the trainer's coefficient, you can write this in full, trainer's coefficient, the trainer's coefficient TC, we take expected return of the security minus risk-free, because normally it is the risk premium, risk premium over what here, somebody, over the risk factor. Risk premium for the security over the risk factor. So divide this by the beta of S. Aya, ABC. Tuone maajabu kwanza. ABC, once I finish this, we are going home right away. Trainer's coefficient for ABC. Hii semester kiliwalemea, hii trainer, iliwalemea oye. Most of them called me after exams, having been injured, telling me, mwalimu, beta coefficient was not given. Is Kasneb your mother? Is Kasneb our mother? It's only our mother really who can be that merciful. I mean, Kasneb, they would want to do other towers, like Kasneb 2, Kasneb 3, Kasneb 4. How do they give you beta directly? Sorry, this is BS, eh? BS. So is there somebody, of course, BS is not given here, but is there somebody who can calculate these betas for us? Is there anybody who can calculate these betas for us? Abracadabra. Can I give you the formula? And J is saying yes. 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 Let me give them time. Beta. And to see whether there is anybody who will be able to get a beta pretty fast. Okay, can I make your work easier by giving you the formula? A is 0.88. Let me see. Yes. Beta A is 0.88, yes. Covariance over variance of market. Pfizer, you are a good student. Pfizer, you are, if it was your birthday today, Pfizer, I would have given you 2,000. Pfizer, myself, I would have given you 2,000. Myself. And please, that story of birthdays has ended, eh? Nobody should come up with those stories that I have a birthday. That story has ended. Is that okay? Let's agree. Let's agree. That story has ended. That story has ended. Have we agreed? Because I'm so sure tomorrow another ninja will come and tell me, mwalimu, now we have a birthday. No. We shall overcome, okay? So I told you there are two methods. There are two methods of getting beta. Number one, we have the covariance approach. And number two, correlation. The covariance approach, we said beta J equals covariance between J and M over standard deviation of the market squared. That's covariance approach. And this is the one that we are using here. Like now, beta A, I will look for covariance of A and the market. So you can see there covariance of A and market. Is there somebody who is able to see the covariance of A and market over here? Anybody who is able to see this covariance of A and market? Quite an ugly figure. 0.0088. So we have here 0.0088, I think. All over the standard deviation of the market squared. What is the standard deviation of the market? What is the standard deviation of the market? Standard deviation of the market. No, not 10. Although here they really misled our students here, because two things. Let me just see that question itself, just a minute. For you to be able to get it very right here, you see, they gave us 0.0088. So then if you want to use this concept of leaving percentages, like now we have their covariance, 0.0088. We have the next one there as 0.075. 0.075. Then we have, in this case here, 0.0021. 0.0021. Wherever. But if you would want to leave, if you would want to leave those, this is not in percentage form. This is not in percentage form. So the very best way, even this standard deviation of the market, don't put in percentage. Let it be 0.1. So 0.1 what here? 0.1 squared. Because this is not in, the others are in form of percentage. This is not in form of percentage. So let this be 0.1, not 10%. So can you kindly then give me this answer finally? Inakuja ngapi hiyo answer? 0.88. I'm being given an answer of 0.88. Ama ni 0.0? Woi, niko peke yangu. Is 0.88, eh? 0.88. So 0.88. Haya. How about beta B as we go? How about beta B as we go? Are you now able to give me beta B as we go? We are going. I can see guys disappearing. We are going. Beta B. Is there somebody who is able to give us this beta B? Oh yeah, abracadabra. Abracadabra. 7.5, right? 7.5. So beta B, you should be able to take beta B 0.075, 0.075 divided by 0.1, because the market does not change, which gives us 7.5, like that, 7.5. Then go ahead, ladies and gentlemen, and give us beta C. So beta C, what do we have there? 0.0021, 0.0021 all over, in this case here, standard deviation of the market, which is 0.1 squared, which will end up giving us 0.21. Thank you so much. So then come back to this as we disappear. Come back to this, ladies and gentlemen. So we have here our trainer's coefficient. It is expected returns of the security minus risk-free all over beta of the security. So we start with the trainer's coefficient for security A. So is there somebody who is able to see expected return of A? Abracadabra. What is the expected return of A? Expected return of A ni ngapi? 17.55. Wewe niko peke yangu, oye. 17.55 minus risk-free ni ngapi? Risk-free ni ngapi? 7. All over beta of A. Beta of A, you guys have given me a figure of 0.88. Beta of A, you guys have given me a figure of 0.88. So please give me an answer. Tell me whether there is any ninja getting 11.99. I'm at 12. 11.99. I'm at 12. That's beta A. Not beta A, but TCA. 11.99. Let me see whether there is anybody who will be able to get the one of B. So long as you're following the formula there. So long as you're following the formula here. Ah, great. You guys are really following. Nowadays, you've become very bright. 0.83, yes. It's about following the formula. Expected return of B. Expected return of B is 13.26. 13.26 minus risk-free rate, which is 7, over beta boy. And the beta boy, you gave me a figure of 7.5. Beta boy, you gave me a figure of, so 0.83. 0.83. How about C? C, what are we getting? Is there anybody for C? Is there anybody getting 11 point something? For C, 11 point something? Yes, 11 point. So C, we are getting 11 point something. So could you kindly go ahead and rank? Which one do you think? Remember, the higher the trainer's coefficient, the better. 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 So it's ACB. So this is the highest, number 1, number 2, number 3. Bye. Thank you very much. Have a lovely night. Tomorrow, should we meet? No. Because again, some of you are working tomorrow, imagine. When I asked around, I'm told some of you are working tomorrow. Thank you. Thank you so much. Or second method, we shall start from there, the correlation coefficient. Alana kona swali ya bonds. Uliza tafadhali, tuko na 2 types of bonds. We have infrastructure bond. Juna bit okay. Remedial class kesho hakuna. Kesho hakuna. Kesho will also want to take time kidogo. Hata nipeleke bibi nje bwana. Nipeleke bibi nje. Yeah. Minimum age for getting to PhD, I mean, no minimum really, but do you want to get into academia? If you want to get into academia like ourselves, start doing PhD very early. But if I were you, there are courses I would really do, because I know Calvin's, if you got that job with one of the big 4, I would not bother to do a PhD, not even at old age. If I were you, I would do so many things in between here. Get DCP Kenya. There is ACCA waiting for you. Instead of PhD, ACCA get, in this case here, ACCA has got professional level. It has fundamental, professional and fundamental. You'll be exempted from all these papers. You do only 4 here. Once you do 4 papers there, then you become a chartered accountant. That will give you an upward mobility in terms of working with international firms. All right. And of course, once you become this ACCA chartered accountant, you only do 2 papers at the University of London, 2 papers at the University of London. You have a master's in professional accountancy. And once you start doing masters from some of those universities, utapata kibali sana. Utapata kibali sana. Utapata kibali sana. Na ukiweza pia, kama lazima ufanye PhD, please don't do it locally here. Don't do it locally here. There is a big problem here. Instead of professors encouraging students to do research, they're stifling research. Unaona explain, nasema now I have this is my conceptual framework. I have these independent variables, so I understand, unakwambia no. So you get like students are really oscillating on the same, because any thesis kidogo unasikia mtu anasema tu mugenda. I mean, people are not really doing research here. If you do these things in international universities, it's a bit pricey, but you will become a very good researcher. Ontology, I mean, so many good things here. If it's literature review, I've done this, these guys have done this topic like that. Which research gap am I coming to tackle here? Ukifanya outside there, you will really be able to move. Hapa sasa maswali zimekuwa mingi sana. Alafu unajua wengi hapa mkuangi guided, It's not even about pitch. It's not even about kuna vitu ambazo ningetaka mfanye sana. Okay, Saka is getting 0.75. Beta of 0.75. Beta of 0. It's because you only took 0.1. You never squared. So unasema 0.075 divided by 0.1 squared. Yeah, you'll be able to get that one at 7.5 Kisaka. Degree cost is equal to CPK, but again, don't be cheated. Of course, in the Kenya qualification framework, they're putting CPA with a degree same level, but it'll take time before corporates and even the government itself takes CPA as an undergraduate degree. So if I were you with CPA, I'll run to KCA here, get my undergraduate, or run to ACCA to get my undergraduate very fast. Because here in Kenya, it will take like 10 years before outside there, like ACCA outside there is recognized like a master's. If you go with somebody who has a master's and you have ACCA to an interview, you'll be rated the same. Outside huko wanakubali, lakini Kenya it'll take time. CFA is very, very good. CFA, if you're talking of investment analysts, very good. But never do that course as your first course. Just like how I laugh at students who do CIFA as their first course. How do you do CIFA as your first course? Which advertisement have you ever seen being advertised outside there calling for CIFA professionals? Very few. I can only do CFA or CIFA after I've established the industry. Maybe nimeenda kwa insurance sector, nimeenda kwa banking sector, and now I'm into investments, etc. Then I'll do that as a secondary course, but not as a primary course. CPA is a good primary course. Now, CIFA, how many papers will I be exempted after CPA? CFA does not exempt you from a single paper. Hata kama uko na masters. CFA International, the US one, you will never be exempted. Never. Tomorrow, no class. Tomorrow, no class. No class. Best degree to take, of course, best degree to take here straight away will be BCom. Ndio kuwe na base. Lakini masters, I will never advise anybody to do masters like in accounting, masters in finance. Waste of time and resources. If I were your age, I'll just go to a university in Dubai or wherever. I do MBA data analytics. This is a big thing I can assure you. Most of these banks will need a data analyst. EABL, Safaricom, they will need a data analyst. The other day, University of Nairobi launched it here, MSc or MBA data, but I'm so sure they don't have resources to really teach it. Do it from outside. Great question here. Why is government borrowing from housing fund to invest in bonds? You see, this affordable thing, housing thing was not taught very well. Because now the government is finding itself in a tight situation. Here they have cut employee salaries as affordable housing. And yet the Chinese and the other contractors who are building these houses, they're using their own money. All right. So basically what the government wanted is to give guarantee to these Chinese people who are building those houses that once you build a house, we shall be able to give you a market. And they never wanted really to have that money. No. What they should have done, government's role would have been to give land and ensure that those guys are able to get a market. Using that guarantee, those Chinese now can go and borrow from banks. But now here the government is finding itself with lots of money that they have deducted, in this case here, from people in the name of affordable housing. Where do they take this money? So the best is to buy treasury bonds. So they lend this money to other things, to government, for government to do other things. Of course, it's an internal lending from one arm of government to another arm of government like that. But how I wish once you guys become policy makers up there, don't cut people's salaries in the name of affordable housing, knowing very well that the government is not supposed to finance those houses. No. The government is not financing those houses at all. Not financing those houses at all. Akuna, not even, even when it comes to selling those houses, there is no subsidy. You're buying those houses at market rate. No subsidy. So ni ukora. Mara mwisho pesa utasikia imepotea yote. Ni ukora. CFE is a very good course. The reader CFE. CFE is a very good course. More than CFFE. Here can be fake. CFE is a very good course. Very good course. Can I explain? Do you have time to explain why CFE is a very good course? Yeah, kuna hiyo maswali mengi by the way, career progression. I'm surprised you guys have never gotten this kind of many questions. You see, CFE is a very good course. I mean, if I were your age, even this time around, I'll do it. You see, CFE, why CFE is a good course? It's a 4 months course. It's tested by what we call ACFE. ACFE. It's an international qualification. You take exactly 4 months and nobody fails. The only undoing is that you pay fees of about 100,000. And then you finish this in 4 months. Once you finish this in 4 months, then you shall register with the CASNEB and do CFFE. CFFE has 9 papers in total. 9 papers in total. Somebody who has got this CFE will only do 2 papers here. You are exempted from 7. So I normally laugh at students who do not know. Students who know this and they have this money, they are working. They always go to this, they get this 4 months and these 3 months. The 2 papers, 3 months. So those are 7 months. As another ninja is fighting with CASNEB here, 3 semesters a whole year, and they are failing in the process. Here you will not fail. Never. This route is much shorter. much shorter, much shorter. Hizi maswali ni mengi. CFA and ACCA and CPA, which one is better? ACCA any day. I finished CPA and I was able to do ACCA. Since I did ACCA, my life has never been the same. Why? Because ACCA, number one, will give you the confidence you need. You know, most people really lag behind in everything that they do because they lack confidence. ACCA, they will be able to tell you that if, for example, you're an ACCA member or even an ACCA student, like the students we have even at Standard Bank, the ones doing physical ACCA and the physical CPA, you can always tell this student here, this student is an ACCA, this guy is doing a CPA. Because the ACCA tells these students here to be very confident in how they speak, all right? How they dress. So normally up there at Standard Bank, you'll get people saying that it's because the ACCA guys come from rich backgrounds. No, it's because of the advice which comes from ACCA. ACCA will tell you that if you're doing ACCA, ensure that you're doing like 1 or 2 international languages. You tend to know so many things at a very young age. So you'll get somebody doing ACCA, and by the time they finish, now they know how to translate financial statements from English to French. That's why you get big companies always preferring what year ACCA, even in terms of skills. You know, ACCA, you can't get me teaching ACCA by writing on the board. You don't write on the board, even as teachers. Everything is Excel, because you also do your exams in Excel. That's how I came to know Excel so much. If, for example, I never did ACCA, I would not have gotten jobs with, I've done jobs with these international companies, big, like my last one before I moved to somewhere else, I'll not tell you, a salary of $1 million shillings because of my knowledge of Excel, pivot tables, doing the dashboards, etc., etc. So ACCA prepares you for the world. So ACCA is way above there. ACCA ni kama Premier League ile huko, whereas CPA ni ya local, ya KFC hapa na ingine nabeba kuku wakienda kwa stadium. Hiyo ndio CPA sasa. Ile ingine international, champions, whatever, like that. Please, I would want to disappear today. I'm doing this from the studio. Nataka kwenda nyumbani mapema. Finance office, I would want you guys to start moving away from finance. I would want you guys to start moving away from finance. After you've done BCom finance, you've done, in this case here, CPA, please get something to take you outside. I would want to see more of my students here doing, for example, courses like grants management, ensure that you are good writers, you're able to write convincing proposals, etc. Because this finance department, in the next 10 years, these robots, utakuwa unahitaji tu mtu mmoja, watu wawili to run the entire finance department. Are you aware of that? Are you aware of that? But in the near future, utakuwa unahitaji mtu mmoja mawili to run the entire finance department. Hakutakuwa na kitu kama receivables accountant, payables nani? Hivi vitu itakuwa. Ladies and gentlemen, I feel these questions are very good, but because I have to drive all the way home, niachilie nikimbie. We shall get time. I don't know kama tomorrow vile ni holiday kesho, maybe nifanye time hii kitu, niwafanyie one session ya career advisory na investments, because there are things I believe that accountants are not aware of, which in the near future they will really catch on you and knock you down as a bad ninja. Because if you are doing CPA and you're not working so hard to be good public speakers, we are not going anywhere. Like public, as machines take over, then we'll be required to be very good public speakers. Good public speakers will always get better and better in terms of what the opportunities outside here. Thank you so much. Good night. Bye-bye. Sorry for not answering 47 questions. I will need to look at them later. We shall overcome.